UPS stock, ticker symbol UPS. This stock is up almost 4% on the year-to-date chart, which is slightly better than the overall market. In this case, the S&P 500, which is up 1.5% year-to-date. UPS beat on EPS by a small margin, but missed on revenue. For the next earnings, all 17 analysts expect to miss, because of several reasons, one of them being a weaker outlook. People love UPS because of the dividends, and with reason of course. Right now, dividend yield is at 3.56%, and it's also growing at a high pace of almost 13% annually. But does this mean that UPS stock is a buy at current prices? Well, in this video I'm going to show you real quickly what UPS does, the most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does UPS do? United Parcel Service, or UPS, is a supply chain management company. It's one of the world's largest shipping couriers. If we check the most recent quarter results, we see that revenue was at 27 billion, down 2.7% year over year, which doesn't look good of course. Margin is at 11.8% and diluted EPS is at $3.96 per share, up 0.8% year over year. UPS also declared a quarterly dividend of $1.62 per share, an increase of 6.6%, which is very nice. Next to that, UPS authorized a new 5 billion share repurchase program, replacing the existing authorization. If we dive in the segment breakdown, we see that domestic segment is up 3.1% year over year in revenue, driven by a 7.2% increase in revenue per piece. International segment decreased 8.3%, driven by a 8.6% reduction in average daily volume. Supply Chain Solutions decreased 18% in revenue due to volume and market rate declines in air and ocean freight forwarding. In here we see that operating profit decreased almost 18% in the fourth quarter, and operating margin decreased from 14 to 11.8%. A decrease of 220 bps, so this is something that I don't like of course. On the full year results we see that margin is at 13% and revenue is up 3.1%, so the fourth quarter was a disappointing one. Return on invested capital is sitting at 31%, up 50 bps year over year, which is something that I really like. UPS really knows how to invest their money. An interesting thing is that if we go back to the segments again, we see that US domestic average daily volume declined almost 4%, so that's not looking that good either. But as I said earlier, revenue was up 3% due to an increase in revenue per piece. But the thing that I like here is the fact that adjusted operating margin expanded to 12.8%, up 60 basis points year over year. The international average daily volume was down 8.6%, also not looking good. Asia is on the rise again, but Europe is still declining. When we check the full year results overview, international is still looking not that great, which concerns me a bit, since it's representing a big portion of the total revenue. For the 2023 full year outlook we see some interesting things. First of all, some uncertain macro environment with rising interest rates, high inflation, recession forecasts, geopolitical environment, and of course COVID issues. But UPS has accelerated investments in projects that drive efficiency and growth, which looks pretty exciting. Also, they developed multiple scenarios for base case and downside plans, which builds in some marginal safety there. If we take a look at the expected results, we see that revenue is expected to be between 97 and 99.4 billion. Which is the same as 2021 and even less than 2022, so that's something to keep in mind. Operating margin between 12.8% and 13.6%, and also dividend payout of 5.4 billion and share repurchases of 3 billion. For the US domestic segment, they expect the average daily volume to go down slightly with the second half better than the first half of 2023. For the international segment, it's pretty much the same story. And for the international segment, they expect revenue to go down low single digits and average daily volume down mid-single digits. So 2023 doesn't look that exciting in terms of growth, to be honest. But of course, there are some exciting things with this company. And one of them being the debt to EBITDA trend. It improved from 3.5 to 1.4, which is a really good number in my opinion. So that's something that I really like, of course. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. UPS is a 158 billion market cap company, which makes them one of the largest supply chain management companies in the world. PE ratio is at 13, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for UPS, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 100 billion, and in this graph we see that revenue went up in the long run. During the lockdown periods, revenue skyrocketed, and right now revenue is slowing down a bit, so that's something to keep in mind. Margins are going up and down quite a bit, so it's not really steady and consistent. Since 2021 it's going up again, but it's expected to go down just a little bit. However, it's still at a pretty good number for this type of company in my opinion. EPS is also going up in the long run, but it's not really steady and consistent. Nevertheless, it comforts me a lot to see it's going up quite a lot over a longer period of time. Price to sales ratio is at roughly 1.85 right now. Over a longer period of time it's increasing quite a bit. The current number does look good to me, but keep an eye on the increase. Price to free cash flow is around 16 right now, which could indicate that they are undervalued based on this number. So this looks really good to me. Analysts expect EPS to decrease in 2023. And after that it will return to double-digit growth in 2025. So they have some tough years coming for them, but after that they expect to increase again. And it's pretty much the same story with the revenue. 2023 and 2024 is expected to be a bad year, but after that revenue is expected to increase at mid-single digits, which is quite good for the size of this company. Return on assets is sitting at 9.7%, which is slightly below my 10% minimum, but this looks still pretty good. Return on equity looks also really good. And the most important number, return on invested capital, is sitting at 30% according to the investor relations and full year results, so the 20% displayed here isn't correct. Nevertheless, both numbers are insane good numbers. UPS really knows how to invest their money. Current ratio is at 1.23, which is very nice, since it's below the 1.5 mark that I prefer, so this looks also quite good. Total debt is sitting at 23.5 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at 14 billion, according to the investor relations and earnings report, so not the 7.5 billion displayed here. With this 14 billion, they can easily pay off a big chunk of their total debt. But it's still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up, but not really steady and consistent, so this is something that I don't like. However, it's going up, so that's the good part. Another thing that I have mixed feelings about are the shares outstanding. It's going down in the long run there, where some periods where they increased their shares outstanding. To me this is very important. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 3.57%, which is a really good number. Annual payout is at $6.48 and payout ratio is at almost 47%. I prefer 15% or lower, so right now they have roughly 53% left in cash to buy back shares, pay down debt, research and development and all other things. The 5-year growth rate is at almost 13%, which is really good. And they grew the dividend for 13 years in a row, which is very impressive. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare UPS stock with the overall market, in this case the S&P 500. Next to that I added their main competitor, FedEx. On the 5-year chart we see that UPS had a 94% return including dividends versus the S&P 500 returning 51%. UPS beats the S&P 500 but also their main competitor with quite a lot of margin. On the 1-year chart it looks pretty different. UPS has the lowest return with -9%, while FedEx is at -6%. The S&P 500 returned -7%. And it's pretty much the same story on the 6-month chart. UPS returned -7%, while the S&P 500 and FedEx also have negative returns, but they are doing a better job there. On the 1-month chart we see that UPS had a -1% return versus the S&P 500 returning -5%, which is also quite a difference. And it's the same with FedEx returning -3.3%. So bottom line, UPS did beat the S&P 500 in the long run, and also the main competitor. To me this looks pretty interesting. But is UPS still a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2%, 5% and 8%, since I think they will increase their revenue at lower numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 11, 12 and 13%. For the free cash flow margin I'm filling in 9, 10 and 11%. For the PE ratio I'm filling in 14, 15 and 16. And for the price to free cash flow I'm filling in the same numbers. I don't want to overpay for the growth, but they have great margins versus their competitors. They have also an insane return on invested capital and EPS looks also pretty good. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now UPS is at $182. I hit analyze and we see a few green numbers. We have a low price target of $117 to $143, which is quite a big drop. We have a mid price target of $166 to $200, which is in the range of the current share price. And we have a high price target of $236 to $279. To me, the mid price target is the most justified here, since I expect the company will face some slowdown in revenue versus historical numbers, but not as much as we are seeing right now. Based on the numbers $166 to $200 range, UPS could be either overvalued or undervalued depending on what your belief is in this range. They are within the middle of this range right now. My final conclusion on this stock is that I really like the business. UPS has been here for a long period of time and I do think it's a future safe business. However, there are some things that I don't like about this company. Declining revenue short terms does worry me a bit, but not every metric is really steady and consistent, such as the EPS, profit margin and free cash flow. But other than that, it's a great dividend growth stock in my opinion. It's still on my buy list and I want to enter a position at 160 or lower. With current market conditions I wouldn't be surprised if we hit that number very soon. Until then I'm waiting for the next quarterly earnings and evaluate this company every now and then. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.